All right, good morning. How to finance your business. From the bank perspective, we got the cash, you want it, so we're gonna try and help you learn how to get it. Just to tell you a bit about myself, 10 years. So I've been at American Savings for 7 years. Before that, Bank of Hawaii. Before that, I was in San Diego doing some merger and acquisition stuff, and then before that, I was in school. I've probably done most bank products that we offer in terms of financing. So revolving lines of credit, term loans, and to give you a flavor, hotel renovations, construction companies, architecture firms, wind farm, real estate, industrial, so a whole gambit of different things. So hopefully if you have any questions, I can answer those. And then I'll let Reed introduce himself.
Yeah, my name's Reed. I'm slightly older than Kyle. When marketing asked us to present, they said we're going to invite the handsome guy from the bank, and for ethnic diversity, we'll just bring the Asian. I've been in the industry for about 15 years. I've worked in banking here solely in Hawaii, Bank of Hawaii. I did things with Morgan Stanley, Merrill Lynch in the banking area, as well as CPB and now American Savings Bank for about half my career. So I'm a business relationship manager. We do small business lending, so right up your alley, so you guys want to be friends with me. But basically, we're here today to talk a little bit about how to finance your business through a banking perspective. So.
And feel free to ask questions throughout the presentation. We want it to be as interactive as possible.
You got one right there.
Are we going to be able to get the PDF for these slides as well?
If you guys don't mind.
Yeah, all our trade secrets are on there, so yeah.
Sure. Okay, so by the end of the class, you will know the 5 C's of credit. I don't know if you've ever heard of that. How to finance assets, little matchmaking. Your cash conversion cycle, that's very important. You should know that and understand it. And then sources of capital. There's really only 2 sources of capital, equity and debt. So equity could be your own cash, angel investors, family and friends, debt, bank, mezzanine, friends and family can also loan you money. And then traditional bank loans, small business, headco, C&I, and then credit score products, and then alternative lending. I really don't have any idea what that is. Reed will talk about that.
Oh yeah, we'll talk a little bit about that.
And then other crowdfunding. Okay. So the 5 C's of credit. Has anybody heard of this before? A few hands? Okay. This is really the core to bank lending. Any banker is going to basically assess your business and you individually on these metrics generally. So these are very important to understand. Generally, if you have all of these in positive, then you should get a loan from the bank. If you don't, come see us. So character. What we really mean by character is credit history, so your demonstrated history of paying back your loans, credit reports, and then just generally what is your reputation in the community and in the business. So that's important. Capacity. When we think about capacity, we think about cash flow to pay back your loans. So what is your ability to repay? EBITDA divided by debt service is a typical metric that the bankers will use. That's important. Debt to income, debt to EBITDA, those are operating leverage metrics. Capital, that's also very important. So if you're going to start a business, think of it like a house. You know, what's your down payment? How much cash are you bringing to the table? Those kinds of things are very important because it gives us economic incentive. If we know that you have your money on the line, you're probably going to be more willing to pay back that loan. Whereas if you borrowed 100% from the bank, you don't have any skin in the game is what we call that. And also access to capital. Do you have a home equity line of credit, right? Do you have other cash, maybe investments that you can pull from? Those things are important in case you get into some issues in the business. And then collateral. Those are the assets to secure your loan. Vehicle, real property, trading assets. Those are like accounts receivables, contracts, basically things that are running through your business. And equipment, you know, whatever equipment you have in your business to operate. We'll take a lien on those assets as collateral. And that helps you lower your interest rates and get a loan. And the last one is conditions. We think that's broadly defined, but purpose of funds. If you have a more specific reason for why you're borrowing the money, that helps. If it's just general, you don't really want to tell us, that makes it a little bit more difficult. And then economic conditions, right? What's happening in our economy, macro, micro level. Maybe some legislative issues. Is there laws coming up that's going to affect your business? Is it going to hurt? Is it going to help? Right? Those kind of things matter. So those are the 5 C's, and Reed's going to go into a little bit more detail when it comes to like an actual bank product. All right, so sources of capital. You guys remember this equation? It's very basic, very important equation here. So yeah, there's basically 2 forms of capital, debt and equity, and they all feed into your assets, right? So this is what finances the assets of your business, which should earn you money, right? This is what earns revenue. So where are these coming from? Are you paying with debt? Are you paying with equity, right? So here, of course, we put in green, bank financing. We want you to come to us for that. So it's just important to understand that perspective, and the more that you have over here, the more leveraged you are. That's higher risk. If you have more equity, it's lower risk. So, any questions so far?
Nope.
Okay. All right, so how to finance your business assets. This is probably one of the most important slides that I'm going to go over. So appropriately matching the asset to the financing. Okay, so we have 2 columns here, assets and your financing. And so we're just going to generally go over different types of assets in your business. So the first one would be trading assets, receivables, and inventory. A bank will generally want to lend you a revolving line of credit on those assets. As you churn your receivables, right, you may have to front cash in order to run your business before you collect on your receivables or before you sell your inventory. So the bank's going to want to give you a revolving line of credit. The next one would be contracts, similar to receivables, but I think service jobs, construction, maybe you're a design firm, maybe you're a consulting firm. We're also going to probably want to give you a revolving line of credit for assets like this. Long contracts, PPA, power purchase agreement. So say you're a company that has a solar PV farm and you have a 10-year contract to sell that power. We're probably want to give you longer term financing. That's a term loan. So if I were to give you a theme here, think of the useful life of your asset. Do you have a long useful life or do you have a short useful life? If it's long, then we're probably going to want to give you long-term financing. We want to match the financing to the asset that you got. So these are a little bit related here. That's why I put them together. Equipment, so say you have your PV equipment and it's tied with a PPA, same thing. We're probably going to want to give you a term loan. So 3 to 10-year term, maybe longer amortization period. And then real property. So you want to buy an actual physical property, that has a long, useful economic life. So we're going to want to give you a term loan there, maybe 30-year amortization, 10-year term. So fee interest, leased fee, leasehold. Anybody familiar with leasehold here? A couple people? That's just where it's a little unique in Hawaii, where a lot of the land is owned by Kamehameha Schools, Queen Emma, right? We have sort of these big institutions that own land, so they won't sell you the fee. They'll let you have maybe a 30-year lease, right? So you have a leasehold position on that real estate. Something we finance here in Hawaii that really only Hawaii banks are probably familiar with. Working capital, cash conversion. So this is also important. Does everybody here know what cash conversion cycle is? A few hands? Okay. So basically a cash conversion cycle, there's a formula here, but in layman terms, it's basically how long does it take for you to take whatever it is you're selling to convert it into cash. That's basically it. So the secret sauce here is if you can collect your receivables quicker than repaying your vendors on time, okay, you don't want to pay them late, then you can basically use cash from your vendors, interest-free, right? You don't have to borrow from the bank as much. So we're going to go through a little example. Let's say you sold a shoe. Let's say you make shoes, okay, for $100. So you have a receivable recorded on your balance sheet. You collect 5 days after sale, okay? You have a manufacturer make your shoe at $50. It's your cost of goods sold. So there's going to be an inventory and payable recorded on your balance sheet, okay? But you pay the manufacturer on the 10th day, right? So you're starting to see a little timing difference here. You collected cash in 5 days. You don't have to pay back in 10 days. Probably shouldn't pay this company early unless you get incentivized to do so. So basically the timing difference between the collection versus the payment gives you 5 days of cash on hand that you can use for, well, there's a number of things you can use that cash for, but basically if you're a growing business, you would probably want to grow. You'd probably want to buy another shoe and sell that shoe in the 5 days, and you can use that cash before you have to pay the vendor back. So that basically means you borrowed money from this entity, the manufacturer, interest-free. So that's cash conversion cycle. Most businesses don't have what we call a negative working capital cycle, but it's important for you to understand this. A lot of business owners get in trouble when they're not collecting on their receivables quick enough, and they're paying their vendors too early, and then they have to borrow on the line of credit, and they max that out, and oh my God, they have to dip into their home equity line and all sorts of stuff. So
if I could just interject. So this cash cycle, this period here where you have this 5-day flow, that's where working capital line of credit will go in. So that's what ASB or other banks or lenders can help with. That working capital line, like Kyle said, when you match the financing need to the asset, this is a receivable coming in. There's going to be a 5-day period before you can collect. We're actually using the working capital line. Good businesses are using that line to finance operations, to finance growth, to finance other inventory purchases while they wait for that receivable to come in and then pay back the line. So it's almost like borrowing on a credit card, right? And then you're going to pay the credit card back every single month.
yeah.
Sorry about that.
No, that was good. Any questions so far?
For all the startups, or for the fairly newer startups, when you guys do like credit history, is that just going to be dependent on the founders?
Yeah, we'll talk about that. We're going to get to that.
Yeah.
Good question, though.
All right.
No, and we're at my part. So, you guys are all in a business plan competition, from what I understand. And you know, from time to time, we do see business plans, especially for startups. And a lot of times, the business plans revolve around, you know, my business and the growth that's going to happen. And there's no realism behind, you know, what actually takes place in the marketplace. But this is just a little funny cartoon. You know, a lot of quick and simple. It's my business plan. It's me and all the money I'm going to make from my business. So, we'll talk about credit score. So if we expand into the 5 C's of credit score being one of the most important things that a bank considers for financing. We have at American Savings Bank scored business loans for businesses. And these loans range between $10,000 to $100,000. What's nice about the credit score loan is they don't require any financial statements. So it's primarily based on the credit FICO score of the borrowers. So the business owners. So any business owner that's over 20% in ownership has to be on that as a guarantor. Okay. What we use to factor into the score are 2 things. One is an Intel score, it's an IPV score. So it's a blend of your personal experience score, because we use Experian as our credit bureau that we pull from, as well as any business trade history. So if you are a business that has been in operation for a couple of years, or even a year, and you have, let's just say, creditors to your business, or you have trade vendors that you work with, and those other businesses that you've worked with, distributors, wholesalers, they've reported positively or negatively against your business, that gets factored into that Intel score, right? So that's one score, it's a business FICO score. And then your personal FICO score. So your personal FICO score, again, we use Experian for this, so it would be your Experian FICO score. Our minimum FICO score guidelines for approval are 660, okay? We use a blend of it, it's the most predictive model. These are some of the factors that affect some of the bank lending. The limited time in business. So if you are a business that's less than 2 years, most likely we will require an SBA guarantee. SBA is Small Business Administration. They are a federal government program. We'll talk a little bit more about that, but that helps guarantee the loan from a bank standpoint. So that helps mitigate the risk of a business that has been in operation for less than 2 years. Low revenue. Understand that cash flow cycles, they vary, right? So there are times where you have high cash flow cycles, low cash flow cycles, depending on sometimes seasonal businesses, sometimes just startup costs have eaten into your business revenue and revenues have been low for the beginning. Low revenue can affect bank lending, but there are ways to mitigate that. High business debt. So you want to make sure that you keep your business debt manageable, right? Your payments that you make monthly towards the business debt, just like on the personal side, can't exceed the revenue coming in, right? Then you're a highly leveraged business. And most likely, we're not going to extend more leverage to you in the form of a bank loan. Unpredictable cash flow. So this is really important. Cash is king, right? So when we look at it as, from a lending standpoint, cash is the primary source of repayment for our loans. So that being said, if we can predict your cash flow cycle is predictable, whereas every month you're getting a consistent revenue coming in, it's easier for us to underwrite a loan understanding where the cash flow is coming from. If you have a business that has unpredictable cash flow, like say you deal in contracts or a service business, right, where maybe some months are a little slower than others, or even retail where it's seasonal, right? Towards the end of the year, maybe sales pick up, but towards the middle of the year, sales have dipped, right? That unpredictability in the cash flow, if it can't be mitigated or can't be explained, it's hard for us to lend to. A low FICO score. So in Hawaii, you see this a lot. Businesses, they start out using their own capital, meaning I've leveraged myself personally, right? So I've taken out credit cards, I've maxed out those cards, I make the minimum interest payment every single month just to keep myself alive, right? That results ultimately in a low FICO score. So this is from experience, about 66% of America is in that good to exceptional range, right? We keep our minimum requirement at 660 for credit score guidelines, 680 for traditional lending, right? So that means you gotta be in this good range to exceptional, right? But what happens is when you start maxing out your credit, your personal credit, right? That affects your score. So these are some things that affect your credit score. The biggest thing, payment history, so pay on time, and then your amounts owed. So when you have high balances on credit cards, oftentimes that affects your score. It's going to lower it because you have less access to capital. Go ahead, Kyle.
Does everybody here know what their own credit score is? Yes?
Yeah.
And you know that you...
Even more
okay.
so than ever, you guys have a better grip on what your credit score are, right? Most credit card companies, they have that free service now that gives you your credit score, monthly when you guys have your card. But keep in mind, a lot of times when you get into this entrepreneurship scenario where people want to finance, start a prosperous business, and don't come to a bank first, or don't go and seek other sources of capital, and they use their own credit to finance this business, that's where people get into trouble. And on the back end, it's harder for us to help you get out of that because you've dug yourself into a hole. Another factor that affects bank lending is your industry. Yeah, go
I'm
ahead.
sorry to interrupt, but just on that point. So one of the things you would look for would not be that you would maxed out your available credit, such as a credit card.
Correct.
Oh,
Correct. So, we want to see lower balances on credit cards, on home equity lines of credit, anything that's on the personal side that's a working capital line. What happens is when we look at the history, if you have a working capital line or a credit card that hasn't revolved, meaning you've kept that $30,000 balance at $30,000 for the last 12 months, it signals to us that there's a difficulty in repaying back the debt, right? Which means that there's some kind of cash flow issue. So that causes us to have to look further.
I'm actually asking from the other perspective.
Okay.
Say you have 3 credit cards that $100,000 is available to you,
Okay.
and you have never maxed them out.
Yep.
How do you look at that? I mean, does that mean you say, well, you can borrow on your credit cards, you don't have to come to us? That's what I'm asking.
Well, so we're not tax experts, so I would go back to the CPA to see whether or not it's advantageous for you to borrow on your credit cards to finance a business. Usually people want to keep it separate, right? They want to take out business debt for business purposes. They want to take out personal debt for personal use. So you may want to just keep that separate from a tax perspective. But on our end, yes, like we take a look at what open trade lines you have personally, what term loans you have on your credit report that factor into a monthly payment. All those things help us calculate cash flow for you personally to be able to pay back the debt, right? So primary source of repayment is cash from the business. The secondary source of repayment for small business lending would be either a financial asset that you have, right, or you personally, because the business owner is so closely tied to the business. Right, on a personal level. A lot of times when you start off, you're a sole proprietor first, maybe an LLC, and then maybe as you expand, revenues get bigger, and for tax purposes, you go into a corporation, right? But at that startup level, you're so closely held to the business. When you take the business owner out of the equation, a lot of times the business is going to fail, right? So we factor in that secondary source of repayment as your personal cash flow as important.
So that will translate into the credit score. If you have large availability under your credit cards and you're not utilizing a lot of it, that's favorable generally to your credit score. When you start maxing it out, that actually will hurt you. So that will all kind of be reflected in the score. Yeah.
Sorry, going back, factors that affect bank lending, the industry that you're in. So there are high-risk industries that pretty much all the banks here in Hawaii are in agreement with that we don't lend to. Bars, nightclubs, adult entertainment type of facilities, cannabis, or anything that has to do with CBD or marijuana now. It's a federal law that we're not banking them. So there are high-risk industries that are going to be affected and we can't serve. But again, have a talk with a banker to see what industry classification your business falls under. From credit risk standpoint, a lot of businesses like in the medical profession, dental, medical, architecture, engineering, very low risk of default, right? So from a bank lending standpoint, we like those types of businesses. But again, industry, it depends on what you guys are doing. To figure out what type of industry classification you are in, there is what's called an NAICS code. When you file your taxes, you're going to file under a classification code depending on the type of business. If you don't know what business type you're in, you can go to this website and search your business industry and you can get a classification code. That's usually what you're going to file taxes under. This is important because from a bank standpoint, we use those classification codes to determine the industry that you're in, whether or not you're high risk or you're low risk, right? So if you don't know already, go ahead and Google yourself through NAICS and then you can find out your industry code. Capacity, Kyle talked about the capacity to repay. So does your business produce sufficient annual revenues and cash flow to make the required loan payments? Right? So after all things are paid out, after all operating expenses are paid out, can you make the loan payment? And oftentimes that's not after you pay out your own salary or your own distribution, right? You want to make sure that you can make that loan payment before you take that distribution out, before you take your own payout, right? How quickly are you able to sell your inventory and or collect on accounts receivable and pay your accounts payable? So Kyle talked about that cash flow cycle, right? As cash comes in, are you paying your vendors on time? Is the business sufficient enough to be able to do that?
And we typically will measure your metrics against your industry, because some industries have longer trade cycles, some are shorter. So, you should probably know what your industry is and what those durations of times are to churn your inventory, and we will likely measure you compared to that.
So this is probably where most of you guys are. If you guys are in an idea stage or early startup stage in business and have little to no revenues, we use SBA loans as a way to guarantee and finance businesses. So how many of you guys are familiar with the Small Business Administration? Yeah, or I've gone and talked to somebody from the SBA. So the SBA, it is an organization, federal government organization that helps lenders like us guarantee repayment on the loans. And it won't be a guarantee from you guys, it's going to force you guys to pay, but it'll guarantee at least the collateral back to us. I'm sorry, not the collateral, it'll guarantee part of the debt. So if you've been in business for 0 to 2 years, ASB would most likely require an SBA guarantee on that. So we're your lending partner. We would use the SBA to help issue out a loan to you as a small business owner. Outside of SBA loans, we do have traditional lending. Kyle talked about that earlier. It's called C&I lending, where we evaluate both your business cash flow and your personal cash flow into a global cash flow scenario to see what your repayment history is like and are you able to pay us back. For that, we require full underwriting. So your business needs to be in operation, have at least 2 years of tax returns and financial statements for at least the full fiscal year. And then we also take a personal financial snapshot on you as an individual to see what types of assets you guys have. Again, because the business owner is so closely tied, you are our secondary source of repayment at most points. And then accounts receivable, accounts payable schedules depending on the type of industry that you're in. Collateral, really important for us because the collateral helps us secure the loans. So assets like real estate or equipment as collateral for term loans, for example. Accounts receivable, inventory, equipment, furniture, fixtures, known as a UCC, for lines of credit. UCC stands for Universal Commercial Code.
Does anybody here know what UCC is? One?
Yeah. So what we do at this point, if we take security around the asset, the business asset, we file with Bureau of Conveyances a UCC filing against the business, which means it puts us in a first priority position to collect if in case something were to happen to the business.
So that's how banks or really any lender will basically, it's like a public notice. It's letting you know as well as the public know that we have a lien on certain assets. So later on, if you are business owners and runners, you'll want to know that. You can search it yourself and see what kind of liens are being placed on your business. You would have to agree to the lien being put, but you know.
Sorry.
Do you guys ever, I guess, finance as second place on the lien?
As a second lien holder?
Yeah.
Typically on a small business lending scenario, no, we'd want to be in first position. Because if you think about a liquidation scenario, right, for a business, a lot of times that primary lien holder is going to pretty much take all of it. And then as a secondary lien holder, you're probably going to be left holding the bag. So for the most part, a lender will want to be in first position on business debt.
On the bigger businesses, you'll see, yes, you'll see some of that. So I've made loans where we're in a second position on a UCC interest, but that will usually come with higher interest rates, right? Higher risk, higher rate. So it's not impossible, but smaller business startup, we will require to be in first. And if we're not, then it's likely a condition that we wouldn't do the loan.
Or we want to refinance the debt that is in first position. Yeah.
How often do small businesses use that as leverage when they're trying to get better rates as compared to
As far as improving a banking relationship, sort of. I rarely do they ever come to us and say, okay, well, we want you to refinance the first position debt, and that's like the way in. From a banking standpoint, we tend to favor businesses that are going to move their banking relationship, right? So what's profitable is the deposit accounts, right? Any merchant services or anything that you're using through the bank. If you're planning to move that relationship along with the debt that's associated with that institution that you're with, then that's an attractive scenario for us, right? To garner the entire picture. We don't want to just take pieces, right? So it's like, well, you can have my debt, but I really like my deposit accounts at First Hawaiian. Probably not that attractive to us to want to do that. So, good questions. A lot of businesses right now, I don't know if you've noticed, but the landscape of business has changed, right? And you can just go to your local mall and take a look at the types of businesses that have vacated and the ones that are being put in its place, right? And a lot of things have changed because of technology and being online. So commercial real estate is something that's actually available. And purchasing it now in this market is actually a favorable thing, as opposed to paying higher and higher lease rents. So I've seen trends as small business owners that are leasing their space, that lease rent year over year is increasing. The cost of being in that space and operating in that space, basically renting that space, is going up year after year. So to fix that payment, sometimes buying the space that you're operating out of is an equitable solution for you. Because what it does is it fixes that payment over the next 25 years, right? If you amortize it over 25 years. And now you own it versus paying a lease rent that year over year, every 3 to 5 years when the lease gets renewed, you're going to have to renegotiate new rates, right? If you do want to buy your space, ASB is a good player in that market. For businesses that have less than the traditional 20 to 25% down payment, right? Think of it like a home mortgage. We partner with a company called Headco. Headco helps buy commercial real estate. They can also finance equipment. They can do debt refinance, and now renewable energy types of projects. So Headco helps by reducing the equity costs from the borrower. So the minimum requirement is now 10% down from the borrower. 40% of the total project cost comes from Headco, and 50% of the project cost comes from a lender like American Savings Bank. So right, that helps us structure a loan so that it's favorable in your terms because you put less down and ability to get into your space and own it now. There is a $5 million lending limit for every single type of debt except for renewable energy that's at $5.5 million. The loans are funded by debenture bonds, and then it gets turned around and sold on the open market. So it's not that Headco has a pool of money that they're just sitting on and they're waiting to distribute. ASB can also finance non-owner occupant and owner occupant. I forgot to put that in there, but commercial real estate loans.
On the Headco piece, they'll give you a 20-year or 25-year term, which a bank will never do. So there's an advantage there. That 40% piece they'll give you a 20-year or 25-year term on real estate.
Thank you.
A bank will only give you 10 years.
And is that going to be coming out to two separate bills? We pay Echo directly and then you guys directly? Or do we just pay you directly and you pass off the rest?
Two separate.
Yeah.
Separate.
And the fees from HEDCO get wrapped up in the loan payment. So that you're basically amortizing the loan fee through HEDCO over a period of time too.
It's a good program.
Yeah. ASP can finance. If you do have the traditional down payment and you don't want to deal with HEDCO and the HEDCO fees, we can do non-owner and owner-occupant types of commercial property purchases. For that, we go up to $1 million, so a little bit on a smaller level. In the competitive market, Banco will go up to about 1.5, but have different types of terms. Our terms and amortization for the loan, we go either 10-year, 25-year amortization, or 15-year fixed with a 15-year amortization. Eligible properties for this are office, retail, warehouse, light industrial, multifamily. Ineligible properties, we don't do lease fee purchases, purchases of raw land, or properties with any undesirable businesses in them, like i.e. adult entertainment or things like that. We don't finance those purchases. Our maximum loan to value is 75%.
You had a question?
Yeah, go ahead.
Is this only for Hawaii, or do you loan?
This is only in Hawaii.
Do you find commercial property that's less than $1 million?
Commercial condos, so those are those individual condo units as part of a bigger plaza or bigger strip mall. Those are less than $1 million. Typically, right now, like I'm just doing one right now in Maui for about 300. So
Some shacks in Kalihi.
yeah,
I financed one of them through HEDCO.
you'd be surprised actually in this market because of the kind of the leveling off of the real estate prices. Commercial real estate prices have kind of dropped a little bit. You know, like I said, a lot of businesses are taking themselves out of a brick and mortar space, going online, right? So commercial real estate properties less desirable than they were in the past. So it would be a good time to pick up some of these properties if you do have a business that could, you know, successfully operate out of them, or you want to be a property owner. Maximum loan to value 75%, which means we require 25% down payment. We calculate cash flow to repay back the loan based on debt service. So the minimum debt service is 1.3, which means for every dollar of debt, we have $1.30 to pay us back, right? So when you do the calculation, we won't go into too much detail, but our minimum global, which includes your personal debts, personal debt service and personal income, is at 1.25. So we do have the ability, in a nutshell, to finance these types of purchases in-house. But for those businesses that don't have the equity to put the traditional 20 to 25% down, it's HEDCO is a good partner for that. Alternative financing. So traditional bank lending is great. I think you're seeing a lot of, especially nowadays, advertisements for alternative types of financing, right? So you can go online, you can apply for a business loan. It's going to take minutes instead of weeks. And you can get, you know, $25,000, $50,000, maybe $500,000, and those are great programs. Cautionary tale to those programs: a lot of times they come with higher fees, they come with higher interest rates, they come with steeper repayment terms, right? Because these are pools of funds by investors that are lending out to small business owners. These are not traditional banks, so just read the fine print of those. The bank will. On a refinance scenario, like we've encountered businesses that have taken down loans from like Cabbage and took out debt from them when they first started up, and then wanted us to refinance that. But because of the repayment terms, it affected their cash flow. So you may want to just be careful with those types. Do your research ahead of time. There are safer ways to finance online. Say you're a retailer and you get merchant receipts every day, right? You take credit card payments, and those credit card payments come in daily. There are companies like On Deck or Square now even does merchant financing, where they will extend you debt based on the average receipts that are coming in every single month. And the repayment terms on that are every single day. At the end of the day, when you clear your batch of merchant receipts, it automatically makes a loan payment for you based on percentage of sale for that day. That's a safer way to finance through merchant financing. So that's an alternative for those businesses that take credit card and have stable income coming in that way. Do you guys have any other questions about alternative finance? We're not going to go too much into that because, you know, we don't deal a lot with alternative financing at the bank. But no? And that concludes our presentation. If you guys have any questions?